Bitcoin was the highest on the list. It was the most directionally correlated with liquidity. So in any given 12-month period, Bitcoin would move in the direction of global liquidity 83% of the time, which was higher than other assets. Gold and stocks were also very high, whereas like bonds were pretty low correlation. And then we did other studies to say, well, you know, if Bitcoin's only correlated with liquidity 83% of the time, what's happening the other 17% of the time? What are the other major drivers? And one of them was valuation. So one of the biggest catalysts for what can give you a 12-month period where Bitcoin goes in the opposite direction of liquidity tends to be when it's starting from a very high valuation. And we measured that in terms of market value to realized value, which is kind of on-chain cost basis. So when you have a really big bull run, the market value goes up a lot, but it's not necessarily a ton of coins trading hands. There's not necessarily a lot of volume locked in at those higher price levels. It's kind of like if you have a street with 20 houses on it and one of them sells for $50,000 more than it sold last year, all the houses on that street go up in estimated price, even though really only 5% of them traded hands, one out of 20. And the same thing happens to a less extreme scale with Bitcoin, that when you have a really big bull run, you know, there's a fairly small amount of volume that's making the value of all coins higher. But some of that is kind of ephemeral. And then over time, generally speaking, you get a weakening of the market cap, and you get a steadily increasing of the kind of the cost basis as more and more coins trade hands. And so generally buying in periods where you have that really big dislocation increases your odds of having a negative year despite positive liquidity. So by looking at both liquidity conditions and looking at relative valuations, that can generally help entities, you know, have a reasonable view of what might happen over a given 12 to 24 month period with the asset. The deficits in the U.S. are likely to continue chopping along. There's even a case that they could narrow a little bit next year because there's some tax cuts that are set to expire, and it depends on the election outcome and the congressional structure at the time to see how that resolves. But either way, they're not going to shrink dramatically, but they're either, you know, they're going to chop around. And so there's this background deficits that are happening. Two is that we're probably going to get to then a quantitative tightening next year by the Fed and certain other central banks. And it's not going to be because necessarily they want to stimulate, but it's going to be similar to September 2019, where there's some little liquidity pocket, and they have to go back to maintaining that ample floor of bank reserve liquidity, unless they want to do things like change the SLR rules or things like that. But that's also a form of liquidity easing. So they're going to have to, I think, pull a couple levers by the end of next year, and that probably means stopping quantitative tightening. Even if you look at the annual report that the Fed put out earlier this year, they even predicted that by the end of 2025, they'll probably go back to the end of quantitative tightening, and they describe it as like they chart out their expectations of keeping their balance sheet at a similar percentage of nominal GDP. So as GDP goes up, their central bank balance sheet goes up, and they're gradually, you know, monetizing some of the deficit, even though they wouldn't use that term. And it's not for the purpose of stimulus, but it's the purpose of not having bank reserves shrink relative to bank assets and relative to the size of everything else. So I do think that, by the end of the next year, we'll have that going on, which is a pro-liquidity move, and you could see that from other central banks. And then I think that, you know, there are pockets of the U.S. economy that are slowing. And rate cuts are not very effective at addressing those for a couple of reasons. One is that so much debt is already locked in at lower rates anyway. So unless you're willing to like cut all the way to zero, which I don't think is going to happen, it doesn't really encourage a lot of new like refinancing and things like that. And two, as you pointed out, that sometimes when you cut the short end, the long end doesn't go down or it goes up. And that's actually what a lot of people are borrowing it, is the longer end. And so I think that I don't really expect an explosive 2025. I think liquidity conditions are not like this big vertical like liquidity party. But I do think that 2022 is a particularly bad year for liquidity. That was an awful year for liquidity. It stabilized in 2023 and 2024, gradually inching back up. And I think that 2025 is either continuing to gradually inch up or could inflect a little bit more quickly up. But I wouldn't necessarily expect fireworks. The other big variable to watch is China. It's not just the U.S. So China is another big variable. They have recently turned toward mild stimulus. in terms of like the value of the stimulus that they're doing. But I think it's an important signal that they're kind of drawing a red line under their current economy. So they're not necessarily trying to like juice it up and pump the property bubble again, but they're slowing down the rate of deleveraging that's happening. And I think that's a pretty big turning point for impacts on liquidity. So I think you have a couple different variables coming together that may not give you an amazing liquidity environment. Like it might not be like 2017 or 2021. But I think it's better than, 2022 is awful, and I think it'll be equal or better than 2023 and 2024. Central bank reports that have mentioned Bitcoin. So the ECB had a report saying that basically if Bitcoin goes up a lot, then it benefits the holders and it punishes the non-holders or the late adopters. But that's true for any asset. I mean, when U.S. tech stocks added, 10 trillion in market cap over a decade, you want to be owning those. You didn't want to be the one not owning those. Same thing if Bitcoin goes up at size. So it's like, they argued before that Bitcoin's done is a bad investment. And then now they're shifting it to, if it's a good investment, then that's also bad because it means that those that don't own it are missing out. And that we should maybe curtail that. We should get all the non-Bitcoiners to help us in our politics against Bitcoiners, essentially. Yeah. And then this other paper basically argued that it's easier to run structurally forever government debts when alternatives are banned or heavily taxed or otherwise impaired, which is true. I mean, basically, when after World War II, a lot of the ways that governments solved the debt problem is they kind of just did capital controls, they banned gold, they forced entities and individuals to own debt, and then their purchasing power got partially transferred to the government to pay off the debt. And then the way that they can and this is where using debt strategically can be helpful. One of the sneaky things is that like capital gains taxes are not inflation adjusted. So if you buy a house and it goes up by 7% a year, and money supply goes up by 7% per year, and then after 10 years you sell this house as an investment, you don't have to pay it. You might have made no like net growth. Like you didn't really grow relative to the money supply. You just kept up with the money supply, but then now you owe a big chunk of taxes just for kind of keeping up with the money supply. So it's actually similar to by being diluted at the end of the day. And they can do that for gold. They can do that for Bitcoin. They can even target to go after assets higher than normal taxes. If they particularly don't like an asset because it's like the best one or something like that, it's giving them the most headaches. And so governments do tend to want to add frictions or costs or taxes to try to recoup the fact that some people are trying to escape the debasement. They want to impose debasement because they want to tax, they want to spend more than they tax because that's popular. But then when there's obvious costs or some people are better at escaping that than others, they want to try to then close those like exit doors or offset those exit doors in various ways. And you see also, emerging markets sometimes do this with dollars. They don't want people owning dollars when they want them to own their own fiat currency, which is debasing even faster. And this is kind of a cycle as old as time, is to try to basically debase the money. It's kind of an invisible inflation tax on the population, and then try to obfuscate or block the exits. And it's funny that the Minneapolis paper just kind of outright mentioned it. It was pretty blunt about it. And there have been other ones. The liquidation of government debt by Carmen Reinhart. It was republished by the IMF, and they're literally just saying that normally you need a captive audience to own the devaluing debt, and they're just saying it. And then they explored like, what if we ban cash? Because if you ban cash, then you could do outright negative interest rates. And the problem is if cash is an option, you can't have like negative 4% interest rates because people would just pull it out in cash. So then they're like, how can we do different schemes to like, this is back during the disinflationary 2010s. They were just kind of like, hey, if we wanted to have super negative interest rates, how can we make it harder for people to escape to cash, let alone escape to gold or Bitcoin or whatever. And this is where using some strategic debt can be helpful as long as you don't get over your skis and get liquidated at the wrong time. Because on one hand, you're owning an asset. It's not being debased very much, but you're getting taxed on the inflation. So some of that's kind of still being put on there. But if you're shorting fiat currency, then your spread is pretty big. So if you own a house unlevered it might not be an amazing investment after taxes and maintenance. But if you own a house with a very low fixed rate mortgage, then that's generally a better investment. You know, and same thing for what MicroStrategy is doing with Bitcoin. They're issuing convertible debt. And it's not like, it's not like you get liquidated on a Sunday night. It's not that kind of leverage. That's kind of unwise kind of leverage, but it's like leverage that they can't just be called on a given time based on Bitcoin price. And so they structurally benefit from the thesis that Bitcoin will keep appreciating versus dollars.